Welcome everyone to the deep dive. This is the show where we really try to take those complex topics, dig into them, and pull out the most important bits of knowledge for you. And today, we're diving into something really crucial, especially for our Canadian seniors. We're calling it Unlocking Canadian Senior Tax Secrets, your guide to a lively later life. Here at the Deep Dive, and really as part of the whole Lively Later Life community, our big goal, our mission, is to help you navigate these golden years well, with real financial peace of mind, confidence, really.
That's right. Financial peace is such a huge part of enjoying later life.
Absolutely. And the topic today, senior tax credits and deductions. Oh boy. For a lot of folks, this whole area feels less like math and more like, I don't know, a puzzle inside a riddle, wouldn't you say?
That's a good way to put it. A puzzle inside a riddle.
Yeah. I mean, I remember for years, tax season felt like this mystery. You gather all the slips, right? Send them off, maybe to an accountant, maybe you do it yourself, and then you just kind of hope for the best.
Fingers crossed. Yeah.
Exactly. And there's always that little nagging feeling, am I really getting everything I'm entitled to? Are there, like, hidden buttons or secret codes I don't know about? You hear about neighbors getting these big refunds, and you think, okay, what are they doing? Am I leaving money on the table here? It's a common thought, I think.
Oh, absolutely. That feeling of being a bit maybe overwhelmed or just uncertain, it's incredibly common. You look at all the forms, the language they use.
Dense, right.
So dense.
Oh, wait.
And the deadlines. It honestly feels sometimes like you need an accounting degree just to figure out what actually applies to your specific situation.
Yeah.
Maybe you've heard terms thrown around, like the age amount or maybe pension splitting. And you're wondering, okay, what is that? Could that actually help me keep more of my money?
Right. Keep more of that hard-earned retirement savings.
Exactly. To enjoy life more fully.
So let me ask you, our listener, part of our lively later life community, how do you feel about tax season? Are you, like, totally confident you're claiming every single thing? Or does it still feel a bit daunting, maybe even intimidating? Just take a second. Think about your biggest tax questions. What worries you the most?
And you're probably not alone in those thoughts. Many people share those same feelings, those same questions.
We get it.
And that's really why we're here today. Our main goal is to, demystify this whole subject. We really believe that a truly lively later life, it has to include financial peace of mind. It's fundamental.
Couldn't agree more.
And understanding your tax benefit, that's a huge piece of that peace of mind. Now, just to be super clear up front.
Yeah, good point.
Neither of us are tax accountants.
Okay.
Right? We're not giving out specific personal financial advice here. That's not our role.
Right.
But what we can do is try to simplify these often complicated rules, empower you with the knowledge so you can feel more confident navigating tax season, and hopefully keep more of your money where it belongs, which is with you.
That's a really important distinction. And it points to something interesting about the Canadian tax system itself, doesn't it? Once you hit 65, the system actually has specific things built in, designed for seniors. It's kind of a recognition, for all your contributions over the years. It's meant to provide some support.
It is. It's structured to acknowledge that stage of life.
So this deep dive today, it's all about showing you how to make your tax return work harder for you. Turn it from something you dread into, well, maybe even a strategic opportunity.
That's the goal.
So lean in, everyone. We're about to unlock some of those tax secrets. Body Section 1, laying the foundation. The age amount and pension income splitting. Okay, let's get into the nitty-gritty. We're starting with two really big ones for Canadian seniors, the age amount and pension income splitting.
Foundational pieces, really.
Yeah, these aren't just small things. They can make a real substantial difference to your bottom line at tax time.
Absolutely. Let's start with the age amount. This is, like you said, foundational. Eligibility. Super straightforward. Were you 65 or older on December 31st of the tax year?
Okay.
If yes, you're eligible to claim it. And for 2024, the amount is pretty significant. It's up to about $8,793.
Wow, okay.
Now, the key thing here is how it works. It's a non-refundable tax credit.
All right, let's pause there. Non-refundable. That term comes up a lot. Can you break that down simply? What's the difference between that and a refundable credit?
Yeah, great question, because it's crucial. Non-refundable means it directly reduces the amount of federal tax you owe. Think of it like a coupon off your tax bill.
Okay, lowers the bill.
Right. It can take your federal tax payable right down to zero, but, and this is the key part, if the credit is worth more than the tax you owe, you don't get the leftover amount back as cash.
Got it. So if I owe $1,000 in tax, and the credit's worth $1,500, it wipes out the $1,000, but I don't get that extra $500.
Exactly. You just pay zero tax. Compare that to a refundable credit, which we'll
Yeah.
talk about later. Those can give you money back, even if you owe zero tax.
Okay, clear distinction.
Now, with the age amount, there's an income test. It starts to get reduced or phased out if your net income goes above a certain threshold.
Right.
For 2024, that's around $41,000.
So higher income might mean you get less of it or none at all.
Precisely. But even with that phase out, it's still a really substantial benefit for a huge number of seniors whose income falls below or within that range. It often significantly reduces or even eliminates their federal tax.
You know, even if your tax software just automatically calculates it, and most good ones do, just knowing why your tax bill is lower, there's power in that, isn't there?
Absolutely. Understanding why is empowering.
It takes away some of the mystery. So for our lively later life community, here's a little takeaway. Your age, it's actually kind of a superpower at tax time.
Huh, I like that.
Don't overlook this one. It's fundamental.
Okay, moving on. Let's talk about pension income splitting. This is another fantastic strategy, particularly useful for couples.
Right, couples. How does that work?
Well, it's mainly for situations where one spouse or common law partner has quite a bit more eligible pension income than the other.
Okay, a difference in income.
A significant difference, usually. The mechanism is pretty neat. The higher income spouse can choose to transfer or split up to 50% of their eligible pension income over to the lower income spouse just for tax calculation purposes.
Ah, okay. So it's not like the money actually moves bank accounts. It's just on paper for the tax return.
Exactly. It's a calculation strategy. You're rebalancing the income between the two of you on your tax forms.
So why do that? What's the big win for the couple? How does that actually save money?
Great question. The biggest advantage comes down to Canada's progressive tax system.
Yeah.
We have tax brackets, right? The more you earn, the higher the tax rate on each additional dollar. That's the marginal tax rate.
Right.
So imagine one spouse has, say, $80,000 in eligible pension income, putting some of that income into a higher tax bracket. The other spouse maybe only has $20,000. If they split, say, $30,000 of that pension income, now spouse 1 reports $50,000 and spouse 2 reports $50,000. You've potentially pulled income out of that higher tax bracket for spouse 1.
And put it into a lower bracket for spouse 2?
Precisely. Reducing the overall tax hit for the household. Plus, there's another benefit.
Oh.
The lower income spouse might now be able to make better use of their own non-refundable tax credits. Things like their basic personal amount, maybe even their own age amount if they're over 65. If their income was very low before, they might not have had enough tax owing to fully use those credits. Splitting income can change that.
So it optimizes the use of credits for both partners. It's like leveling the playing field tax-wise for the couple.
That's a great way to put it, leveling the playing field. It can lead to, noticeably lower total tax for the household compared to just having one person record all that income.
Can you give a quick example, like with some numbers?
Sure. Let's say one spouse has a large private pension, maybe $70,000 a year. The other spouse has only CPP and OAS, totaling maybe $15,000. If they split the maximum 50% of that $70,000 private pension.
So $35,000 moves over on paper.
Right. Now, spouse 1 reports $35,000 pension plus their CPPOS, and spouse 2 reports the transferred $35,000 plus their own CPPOAS. Their taxable incomes become much closer. This shift could easily move thousands of dollars from being taxed at, say, a 25% or 30% marginal rate down to maybe a 15% or 20% rate. That could mean savings of hundreds, maybe even thousands of dollars a year.
Okay, that makes it very clear. So what's the absolute key thing people need to know to figure out if this even applies to them? And you mentioned eligible pension income. What counts?
Yeah, 2 critical points there. First, the LLL smart tip, if you will. Pension splitting really makes the most sense when there's a significant difference in eligible pension income. If your incomes are already fairly close, the math might not yield much benefit, or any at all.
Makes sense. Don't bother if incomes are similar.
Pretty much. Second, and this is vital, what counts as eligible pension income? Generally, we're talking about payments from private pension plans, like from a former employer, also payments from a registered retirement income fund to RRAF, and certain annuity payments.
Okay, so mostly income from savings or employer plans.
Usually, yes.
Yeah.
What's not eligible? This is just as important. You cannot split old age security, OAS payments, or Canada Pension Plan, CPP benefits.
Ah, okay. So government benefits are out for splitting.
Correct. Those have their own rules. They're not considered eligible pension income for this purpose. So the absolute takeaway, always check if this strategy actually benefits your specific household income situation. Look at the types of income you both have.
Then maybe run the numbers both ways or get advice.
Exactly. Most tax software can do the optimization calculation for you, but understanding the principle helps. And if you're unsure, definitely check the CRA website or talk to a tax professional. Getting this right can be a really big win. Body Section 2, Beyond Income, Healthcare and Home Accessibility Credits.
All right, so we've talked income, we've talked age, but there are other really important parts of life as we get older that the tax system recognizes, right? Like health and making sure our homes are safe and comfortable.
Absolutely critical areas. And yes, the tax system offers support here too. Let's start with the Medical Expense Tax Credit, the METC. This is a big one for many seniors.
And it covers more than people think sometimes.
Way more. Often, you can claim eligible expenses for yourself, your spouse, or common law partner, and even dependent children under 18. And the list of what counts is pretty broad.
Like what? Give us some common examples.
Okay, well, the obvious ones. Prescription medications, dental work cleanings, fillings, dentures, implants, eyeglasses, contact lenses, hearing aids, and their batteries.
Standard stuff.
Right. But also premiums you pay to a private health services plan, like Blue Cross or similar extended health benefits, maybe through a retirement package.
Ah, okay, the premiums themselves count.
Yes. Travel expenses can count too if you have to travel more than 40 kilometers.
Yeah.
One way to get necessary medical treatment that wasn't available closer to home. There are rules around that, of course, for meals and accommodation.
Okay.
And interestingly, the cost of certain renovations you make to your home specifically for medical reasons can sometimes be claimed here too, or under the accessibility credit we'll discuss next. Things like ramps or modifying a bathroom for mobility issues.
This sounds like we're keeping really good records as absolutely non-negotiable.
You said it, non-negotiable. I like to tell people, think of every single medical receipt, that pharmacy slip, the dentist invoice, the payment for physio. Think of them as tiny gold nuggets.
Huh. I like that analogy, tiny gold nuggets.
They really add up. Don't underestimate them. Every prescription, every specialist visit, keep.
Yeah.
Every receipt.
So practically speaking, what's the best way? Just a shoebox.
A shoebox is better than nothing. But maybe a dedicated envelope or folder for the year, labeled medical receipts 2024 or whatever. Or if you're digital, scan them or take photos and save them in a specific folder on your computer or cloud storage. The key is having a system so you don't lose them or forget.
Good advice. So how does the credit actually get calculated? Is it dollar for dollar?
Not quite dollar for dollar. It's a 15% federal credit, but it only applies to the portion of your eligible expenses that exceed a certain threshold.
Ah, okay, a threshold. How does that work?
The threshold is the lower of two amounts, either 3% of your individual net income for the year or a specific dollar amount set by the CRA each year. For 2023, it was around $2,635. It adjusts annually.
So you need to have enough expenses to get over that hurdle first.
Exactly. You gather all your eligible expenses for the 12-month period you choose ending in the tax year, subtract that threshold amount, and then you claim 15% of the remainder as your federal credit. There are also corresponding provincial credits.
Can you expand a bit on those renovations for medical reasons? What kind of things might qualify there, specifically under METC? And what are common mistakes people make with this credit?
Sure. Under METC, renovations need to be pretty directly linked to enabling function or mobility due to a severe, prolonged impairment. We're talking things like installing devices for vision or hearing impairments, modifying kitchens or bathrooms for wheelchair access, maybe even furnace upgrades if required for respiratory ailments. Often, you'll need a prescription or certification from a medical practitioner linking the renovation to the specific medical need.
Okay, so documentation is key there, too.
Absolutely. Now, common pitfalls. Big one. People just don't realize how many things can be eligible. They forget about travel or premiums or maybe costs for therapy animals under certain conditions. They just think drugs and dental.
Right, underclaiming.
Exactly. Another one is not quite meeting that income threshold. Maybe your expenses are significant, but just under that 3% of your net income, so you don't get the credit that year. Sometimes strategically choosing your 12-month claim period can help bundle expenses together if possible.
Ah, interesting. You can choose the 12-month period.
Yes, any 12-month period ending in the tax year.
Yeah.
So if you had major expenses late one year and early the next, you might choose a period that captures both. And, of course, the biggest pitfall is just not having the receipts to back up the claim if the CRA asks.
Keep those tiny gold nuggets.
You got it. Okay, moving on to home accessibility, which ties in nicely. There's the Federal Home Accessibility Tax Credit, the HHEC.
The HHEC.
This is also a non-refundable federal credit, like the age amount. It helps cover the cost of specific renovations that make a home safer or more accessible for a senior, 65 plus,
Mm-hmm.
or someone eligible for the disability tax credit.
And what's the value here?
You can claim up to $10,000 in eligible expenses per qualifying home. The credit itself is 15% of those expenses, so it can reduce your federal tax by up to $1,500.
Okay, $1,500 potential reduction in federal tax. What kind of renovations count?
Think safety and accessibility, installing grab bars, walk-in tubs, wheel-in showers, building ramps for access, widening doorways, lowering counters, installing a stair lift, things that allow someone to move around and use their home more safely and independently.
Things that really help with aging in place.
Precisely, that's the whole point.
Now, you mentioned this ties into provincial credits too, especially here in BC, right?
Yes, this is where it gets layered, in a good way. For residents of British Columbia, there's also the BC Home Renovation Tax Credit for seniors and persons with disabilities.
Okay, different name, provincial level.
Exactly. Provincial. And its focus is similar. Permanent renovations for accessibility, safety, or function. Now, the BC credit allows you to claim eligible expenses up to $10,000 as well.
Hold on, you said the federal was up to $10,000.
You're right, my mistake there. The federal HATC limit was increased. It's actually up to $20,000 in eligible expenses now for a maximum federal credit of $3,000, 15% of $20,000. Thanks for catching that.
No problem, important detail. So federal up to $20 expenses, max 13K credit. What about the BC one?
Okay, the BC provincial credit lets you claim up to $10,000 in eligible expenses.
Huh.
But here's the really exciting part about the BC credit.
Yes.
It provides a refundable credit of 10% of those eligible expenses, up to a maximum credit of $1,000.
Refundable. Okay, let's unpack that again. How does refundable make such a big difference here compared to the federal non-refundable one?
It's a huge difference, especially for lower income seniors.
Mm.
Remember, the federal HATC is non-refundable. It reduces your federal tax, but only down to zero. If you spend $20,000 on a stair lift, you might qualify for the full $3,000 federal credit. But if you only owed $1,000 in federal tax to begin with, you only use the $1,000 of that credit. The other $2,000 just disappears, effectively.
Okay, so you need enough federal tax owing to benefit fully.
Right. But the BC provincial credit, being refundable, means you can get up to $1,000 back as a cash payment, even if you owe zero provincial tax.
Wow. So back to that $20,000 stair lift example.
Okay, you claim the $20,000 federally, potentially getting up to $3,000 off your federal tax bill. Then, provincially in BC, you claim the first $10,000 of that expense, since that's the BC limit. And 10% of that is $1,000. So you could receive a $1,000 check or deposit from the BC government, regardless of your provincial tax situation.
That's fantastic. Cash back for making your home safer.
It's a really powerful incentive to support aging in place. It makes those sometimes costly but necessary modifications much more affordable. And yes, you generally need detailed invoices from contractors, proof of payment, and clear descriptions showing the renovation qualifies.
So any overall tips for both the medical and the home accessibility credits, like a quick checklist?
Okay, LLL's smart tip, time for both. First, confirm eligibility. Are the expenses really for medical needs or qualifying accessibility renovations? Check the CRA lists. Second, keep detailed proof. Invoices, receipts showing exactly what was done or purchased, who it was for, when, and the cost breakdown. Third, don't guess. If you're unsure about a specific expense, look it up on the CRA website or ask a tax pro. There might be surprising things that qualify or rules you didn't know about.
Makes sense. What counts as detailed proof? Like, is a credit card slip enough?
Usually not just a credit card slip. You need the actual invoice or receipt from the provider or contractor. For medical, it should show the patient, the service product, the date, the cost. For renovations, you need the contractor's business info, a description of the work tied to accessibility safety, breakdown of costs, labor, materials, dates, proof of payment. Photos before and after can also be good supporting documents.
Right. And when should someone definitely ditch the DIY approach and call a tax professional for this stuff?
I'd say definitely consider a pro. If you have very large, complex medical claims involving things like attendant care or significant travel, or for major renovations where you're trying to claim both federal and provincial credits and want to ensure all documentation is perfect. Also, if you're managing claims for multiple family members, or if there are interactions with disability credits or other complex factors, sometimes the fee for professional advice is easily offset by the tax savings they find and the peace of mind you get knowing it's done correctly. Body Section 3. Navigating further. Other benefits and common tax pitfalls.
Okay, so we've covered some heavy hitters. Age amount, pension splitting, medical, home accessibility, huge benefits there. But let's broaden out a bit. There are other benefits, maybe smaller, but still important, and definitely some common mistakes or traps people can fall into.
Absolutely. It's not just about the big credits. Let's touch quickly on the GST-HST credit.
Right, that quarterly payment some people get.
Exactly. It's tax-free, paid out 4 times a year. It's designed to help offset the sales tax paid by individuals and families with low or modest incomes. Many seniors automatically qualify based on their income reported on their tax return.
So no separate application needed.
Generally, no. If your income is within the range, filing your tax return is usually all you need to do to be assessed for it. It's just another reminder of why filing is so important.
And sticking with that theme, especially for our BC listeners, there's another provincial one worth mentioning, right? The Climate Action Credit.
Yes, the BC Low-Income Climate Action Tax Credit, or CATC. Similar to the GST-HST credit, it's a tax-free payment, usually quarterly, aimed at helping lower-income residents offset the costs related to the provincial carbon tax.
And again, key point here.
File your taxes. This is another one of those refundable credits.
Yeah.
You only get assessed for it if you file an income tax return, even if you have zero income to report and owe no tax.
It seems like that's the recurring message. File your return no matter what.
It really is the gateway to so many benefits. Let's quickly expand on that refundable idea again because it's so important. Unlike non-refundable credits that just reduce tax you owe, refundable credits mean the government actually sends you money if you qualify, even if your tax bill is zero.
Like the BC renovation credit and this climate credit.
Exactly, and the GST-HST credit. For a senior on a fixed low income, these quarterly payments can make a real difference in managing monthly expenses. They're designed as direct support, but the system only knows you're eligible if you file that return. If you don't file, you simply miss out on that money, period.
Okay, message received loud and clear, file. Now let's switch gears to the pitfalls. What are the common traps seniors should watch out for?
Okay, trap number one, and we've kind of been circling it, not filing a tax return because you think your income is too low.
We just covered why that's bad for refundable credits. Any other reasons it's a mistake?
Yes. Beyond missing out on direct payments like GST-HT or CATC, you also need to file to establish your eligibility for the non-refundable age amount, even if it doesn't result in tax owing that year. Filing also generates RRSP contribution room, which might seem irrelevant in retirement but could be useful if you have some part-time work or for spousal RSPs. Plus, mid-provincial programs like property tax deferrals or senior supplements often require your income to be assessed by the CRA based on a filed return. Not filing effectively cuts you off from the system.
Okay, big mistake not to file. What's trap number 2?
Trap number 2, not keeping good records. We talked about this with medical and renovations, but it applies broadly.
Right, those tiny gold nuggets.
Exactly. Tax time often requires proof receipts, statements, documentation. If your records are a mess or non-existent, you simply can't claim things you might be entitled to. You know you paid for that hearing aid, but if you can't find the receipt, tough luck on the claim.
So, our LL kick here, think of your filing system, even a simple one, as your financial safety net. Seriously, grab a folder, label it tax year, and just consistently put relevant slips and receipts in there as they come in. It saves so much stress later.
Couldn't agree more. It saves headaches and potentially real money. Okay, trap number 3, relying on outdated or unofficial advice.
Ah, like advice from Uncle Bob who did his taxes back in the 80s.
Exactly. Or maybe just information from last year. Tax laws change. They really do. Credits get introduced, amounts change, rules get tweaked. What was true last year might not be this year.
So where should people get reliable info?
Always go to the source, the official Canada Revenue Agency, CRA, website. It's detailed, searchable, and up-to-date. They have specific sections just for seniors. Or use reputable current year tax software. And if your situation is complex, consult a qualified tax professional who stays current. Don't rely on hearsay or old forum posts.
Good point. Relying on old info could mean missing new benefits or making incorrect claims.
Precisely. It's about being accurate and ensuring you're working with the current rules. Outro.
Oh, wow. Okay, that was definitely a deep dive. We've really covered a lot of ground today, haven't we? From the basics, like the age amount, the strategy of pension splitting,
Through to those really important health and home accessibility credits.
and wrapping up with other benefits and those common pitfalls to avoid. Hopefully this helps demystify things a bit.
That's the whole idea. Remember, everyone, understanding these tax benefits, it's really more than just saving a few bucks, although that's great too. It's truly about feeling empowered. Knowing your rights as a taxpayer, feeling confident you can claim what you're entitled to, That helps build strong, stable retirement finances, which is key for that lively later life we talk about.
Absolutely. Being tax savvy isn't about being greedy or trying to pull a fast one. It's just about being resourceful. It's making sure every dollar you've earned or every benefit you deserve actually stays with you. That money enables a more vibrant, maybe less worried later life.
Well said. And if this conversation today helped clear things up for you, maybe give you a new idea for savings, we'd love it if you'd hit that like button below.
Yeah, let us know.
And here's the big ask. Please consider subscribing to our channel, the Lively Later Life channel. Make sure you click that little notification bell too.
Please do.
We're really committed to bringing you more valuable tips, more deep dives like this one, all aimed at helping you create a truly fulfilling and, yes, lively later life.
And before we wrap up, we genuinely want to hear from you, our community. What's one tax tip or benefit that you found particularly useful as a senior living in Canada?
Yeah, share your wisdom.
Drop in the comments below your experience, your insight. It could seriously help someone else in the lively later life family save money or reduce stress. Let's learn from each other.
Absolutely. And maybe a final thought to leave you with. Think about this. In today's world, things are always changing, especially financially. Real financial security often comes not just from what you earn or receive, but from how well you understand and manage what you actually get to keep.
Good point.
So, armed with some of this tax knowledge, what other part of your financial well-being are you going to deep dive into next?
Something to ponder. Join us again next time on The Deep Dive for more insights to help make your golden years truly golden.
Until then, stay savvy, stay active, and keep living your lively later life.